it's been a long time since we've had this affordability crisis. There's much talk about the government's policies, to which I've just spoken with Peter. He seems very pessimistic about, especially the 90,000 plus units that are expected to come in 3 to 4 years. He's going to elaborate on these issues and the effectiveness of these policies, and also where the industry is headed next. Peter is a real estate market commentator, analyst, investor in the Asian markets for the last 3 decades. Spent 15 years at Morgan Stanley as head of Asian real estate research, regional strategist and head of research for Asia, and he also subsequently founded Asia's first listed and physical asset real estate fund in 2004. Currently, he's a speaker of the chairman of Churchouse Property Planners, a Hong Kong-focused private equity real estate vehicle. He also releases the Churchouse Letter. Everyone give a warm welcome to Peter Churchouse.
Nan, hi, thank you very much for that introduction. I've found over many years studying and researching the Hong Kong market that I'm always daunted when I get to talk about the real estate in Hong Kong. Everybody in Hong Kong is an expert in real estate. I can see a lot of them sitting around this room today. You know, your taxi driver, he can tell you to a T what prices are doing in Sheung Shui or Sha Tin. The doorman at the Mandarin, every time I walk in, stops me, asks about what I think is happening in real estate. What do I think of Chung Kong? Sanakai too expensive. You know, so everybody's an expert. I remember when I first came to Hong Kong in 1980, I was leading the planning of Tin Sui Wai Newtown with a team of 70-odd consultants, and I had a young local architect guy who'd trained in the UK on my team called Victor. And Victor said to me fairly early in my stint, he said, Peter, he said, you're going to realize that in Hong Kong, we Chinese understand 2 things really well. And I said, well, what's that, Victor? And he said, gold and real estate. Well, it proved that I think he was pretty much right about real estate. But what I did learn in time was that people in Hong Kong are just as prone to the excesses and the hubris and the excess exuberance in real estate as people in many other parts of the world. So what I plan to do today here really is just look at various themes within real estate in Hong Kong. I've always found real estate one of the best investments I've ever made, and I think a lot of people in this room probably have found the same thing. And people like Andrew Carnegie, John D. Rockefeller, are some of the leaders of the charge. The quote at the bottom here is one that I find really interesting. Ivana Trump. I've always felt secure and very safe with real estate. Real estate always appreciates. Well, sweetie, we know the difference, don't we? Well, I think the big trends in real estate over the last 30 years, it used to be very much a local business. It's a bit like Milton Friedman says that inflation is always and everywhere a monetary phenomenon. Well, kind of real estate always used to be a local phenomenon. But over the last 25 years, it's become much more of a global phenomenon. It's driven much more by macro forces. So what goes on in Hong Kong, the UK, the US, is not just local forces, but much more global forces, as we've seen capital flowing around the world, we've seen trade broadening, we've seen just this massive globalization. Just a chart that really, I think really sets the scene for where we are in the world today in terms of the macro environment. This chart shows basically, I think it's a pretty scary chart to be honest, but there's 3 lines, which is international trade growth, industrial production growth, that's global industrial production growth, and business confidence. And you can see 3 periods in this chart. The first chart was pre-GFC, first part of the chart. The middle was GFC, the big decline, and then the big boost back up again, and then post-GFC. And I think there are 2 key points that I take away from this chart is that the indicators that we're looking at, these 3 global macroeconomic indicators, are running at about half the levels that they were pre-GFC. So this is telling you the economy globally is in much slower mode than it used to be. And secondly, if you look at the right-hand end of that chart, what is even more disturbing is all of those indicators are pointing downwards. They're now in negative territory. Global trade growth is now in negative territory. So this doesn't look like a world that's really recovered, particularly from the GFC, and in fact looks like it could be heading into another recession. As we know, you've all seen this chart. This is interest rates, record low global interest rates, and so on and so forth. And of course, what this has meant, this period of zero or very, very low interest rates has been pretty good for owners of financial assets, whether they be stocks, bonds, or real estate. And it's not great, of course, if you are a saver, if you're a pensioner, depending on a coupon from bonds or from insurance premiums. It's not good for people in that position. But the property markets around the world have really recovered very nicely following the zero interest rates or low interest rates post-GFC, whether it be San Francisco, Sydney, Singapore, Hong Kong, everywhere, major cities have all recovered. Secondary cities are coming up more slowly. When we think about it, Asia was the first market to recover post-GFC. Much more quickly, in fact, than the European markets and the American markets. And it was Asia that first introduced property cooling measures around 2010, 2011, right through Asia, in China, Hong Kong, to a lesser extent in Taiwan, certainly in Singapore, less extent in Malaysia, even to some extent in Indonesia. So these countries introduced these macroeconomic cooling measures in response to the capital flows that came into these markets post-GFC. So if we look just a very quick snapshot at where we are right now, it's been a bit of a roller coaster in the last 12 months and 18 months, 2 years in Hong Kong. If you think about it, from August last year till March this year, residential property prices fell by about 12.5% to 13%. But since March, April, they've already rebounded by 11%. They're not quite back where they were at that time, in August of last year. So this has been a pretty sharp, V-shaped downturn and a very quick recovery. A lot of people say it's all been attributed to the cooling measures that government's put in place. I can't agree with that. I don't think that's the case. I think the downturn that we saw really was more than anything a response to the collapse in the China stock market. Stock market and property market in Hong Kong tend to be highly correlated, and that's the collapse in the China stock market, I think, hit sentiment here pretty hard as well. Also, the renminbi devaluation that we saw in August of last year hit confidence pretty hard. There was a huge amount of global concern about the China economy slipping into much lower growth. So we saw a lot of macro factors here, which I think really affected the property market more than what we tend to think as the government cooling measures. And of course, the recovery has come about since we've had an easing of concerns on the renminbi, a bit of an easing of concerns on the China economy. So that recovery has happened pretty quick. But if we look at Hong Kong's real estate market, residential market, it's by far the most volatile in the world. I'm pretty much convinced of that. I've never seen, with all the charts I've looked at around the world, I've never seen a country that's had quite as volatile a real estate market as we've had here. There are lots of reasons for this, partly because it's a very small, open economy. You get capital flows in and out. There are no capital controls here. Nobody's forbidden from investing here, taking their money in, taking their money out. There's always been this question that land shortage drives the property market here. Well, I don't agree with that at all. The PEG, I think, has been one of the key drivers of volatility in this market over the last 35 years or 30-odd years. If you think about it, Hong Kong is destined to periods of inappropriate monetary policy when we're pegged to what the Fed wants to do. For example, in 1997 to 2003, Hong Kong was in a recession, was in deflation. We needed lower interest rates, but we couldn't get them. And in recent years, we probably needed higher interest rates, but couldn't get them. So the PEG creates this incipient volatility in asset markets. But the interesting thing in Hong Kong, I think, is we've learned to live with this. The other area which I think has is led to volatility is public policy. Let's face it, land policy is the backbone of fiscal policy in Hong Kong. Fiscal policy is almost hugely driven, to a large extent driven, by revenues from real estate related sources, whether it be land premiums, sale of land, change of use premiums, stamp duties, whatever. Up to 30 to 32% in various years of government revenue has been driven by real estate. So there's a huge vested interest on the part of government to keep land prices high. So on the one hand, you might be getting the executive saying, oh, must have more affordable housing, but on the other hand, they're telling the lands department to curtail land supply and keep land prices high because we need the money. So there's a real conflict of objectives here in the government, and I think that helps increase the volatility in Hong Kong. But as an investment, real estate around the world has been a terrific investment. I know a lot of you have invested in other parts of the world, but if we look at the last, back to the early 80s, compound annual growth rate, despite all the volatility of residential real estate, is about 7.3, 7.4% over that period. You add on top of that a rental yield, perhaps as an investor, a rental yield probably averaging over that time maybe 4% or so, you've had 11.5% compound annual growth or annual return on your investment over that period. I'm not sure you've had that in too many equity markets around the world. And when I've looked at this spread, the spread over inflation in Hong Kong is quite high. Inflation's averaged over that period about 4%, 4.4%. So you've had a 300 basis point spread of capital growth over the rate of inflation. So your real return has been pretty darn high. And you add the rental yield on top of that, you've had a pretty good return. In fact, if I look at the same figures for many other cities around the world, yes, Hong Kong's annual growth is amongst the highest, but its spread over inflation is actually lower than cities like London, Sydney, Vancouver, and Paris. So these cities have actually done better inflation adjusted than even Hong Kong. One of the big things we always talk about here is supply. This chart just plots the supply of annual supply of private housing going back to 1972. You just see where we are on the right-hand side of this chart. Historically, Hong Kong has produced between 23,000, 29,000 private sector units a year over decades. Over the last decade, that number has dropped to around 11,000 on average. And then, in fact, it dropped well below 10,000. So we're producing well under half the amount of housing that we've done historically. Now, that kind of tells me something. There's something wrong here. So if you think about it, we can get all intellectual about property and all the causes of it, but quite frankly, basic economics 101, if you curtail supply and you've got a strong need and a demand and affordability, that's going to mean prices rise, which is exactly what's happened. Now look at the supply going forward from here. We're in a slightly different situation. This chart here looks at supply under varying stages of construction. The blue bar is the private housing under construction but not yet sold. You can see going back around the SARS period, about 40,000 units a year. That's up to 65,000 units a year. So we are definitely seeing a bit of a pickup in supply potential coming forward. So this is under construction but not yet sold. The green bar is the inventory. That's what the developers have on their books, completed but unsold. And you can see it's tiny. These guys don't have a lot of inventory. Not like China, where they've got years and months of inventory. They don't have that in Hong Kong. And the yellow is really the land bank. That's sites that have been sold to the developers but not yet developed. So this, you could argue, is land bank. And you can see that's risen quite dramatically from about 5,000 units a year, 5,000 units back in 2009 to about 22,000 units today. So there clearly there's some supply coming down the pipeline. But the point that I would make about supply in Hong Kong is that over the years, I've tracked this going back to 1972, 73. Rating and Valuation Department does a survey each year and publishes what they think the supply is going to be this year and the next year. Well, you go back and check those numbers and actually and look at what was actually created. Their forecasts are on average out by 23%. So if they said there was going to be 15,000 units created, it was probably more like 12,000 units. So this 90,000 units we keep talking about, I will be extraordinarily surprised to see that actually come to fruition. It will be the first time in history if it does. So don't believe the 90,000 figures too much. So this chart here looks at volumes. And you can see we've highlighted there the SARS period, when that was probably the worst period in decades for take-up of housing. But look at where we are. And of course, in the GFC, the supply take-up of housing dropped pretty quickly. So this is total sales, primary and secondary. And you can see where we've been at the back end of last year and the early part of this year. We were at record low levels of supply or of take-up of housing stock in Hong Kong. Volumes of transactions dropped to 2,000 to 3,000. I have never seen that in 35 years in Hong Kong. Now, that was a pretty extraordinary situation. So what we've seen since March, April is a pretty sharp pickup in take-up of housing and sales and purchases. Just looking at this as a rule of thumb, what I find if we're seeing transactions much over 10,000 a month, that kind of suggests we're in excess exuberance, maybe bubble territory. If we're much below 5 or 5,500, we're getting into bear market territory. So the bears are stalking at under 5,000. Well, they were certainly stalking in that second half of last year. Just looking at vacancies, you know, I keep hearing from various people saying there's hundreds of thousands of vacant flats out there not being used. Well, I'm not convinced by that either. This chart looks at the vacancies by various property types, and the residential is the light blue line. I think there are a couple of points we can make on this. Firstly, over the last decade, vacancy rates in pretty much all forms of real estate have declined pretty steadily over that period. And right through that period, residential vacancy rates have been the lowest of any sector. And looking ahead, we can see residential vacancy rates don't look like at this point they're picking up, but they certainly do seem to be picking up in retail, which we're probably all fairly aware of, and to some extent also in the office market. But vacancies in residential doesn't look like it's going to be a problem short term, at least anyway. Just looking at the difference between the luxury market and the mass market, I know this is probably a bit irrelevant, really, but the luxury market, we all see the press and all the write-ups in the newspapers and so on. The luxury market for units over 160 square meters is about 2.3% of the private sector stock. It's a tiny part of the market, but it gets a heck of a lot of coverage in the media. The mass market, vacancy rates have been steadily declining, and have been coming down really for pretty much more than a decade now. So we might hear a lot in the press about the luxury market, but just remember it's pretty much irrelevant to the overall market, the people in this town. And just look at the difference in pricing between the luxury market and the mass market. This chart shows that if the line is rising, that tells you that the luxury market is outperforming the mass market in terms of price appreciation or price movements. There can be price appreciation or price declines. But you can see in that period up to the GFC, the luxury market was doing much, much better than the mass market. Well, since the GFC, well, the bankers have been bashed, and of course the luxury market has turned down relative to the mass market since that time. So the mass market in recent years has been doing much, much better than the high-end luxury market. Just looking at pricing in terms of ticket sizes, this looks at the proportion of total sales in certain price brackets. And if we look at anything in the light blue and below, That's units under $3 million. And you can look back at the SARS period, 85% of property transactions were below $3 million. You look today, that's about 15%. So you can see the ticket sizes have risen much more rapidly than perhaps household incomes over that time. This is a bit messy, this chart, but it's basically looking at the yields that we get on various forms of residential property. The dark blue line at the top is the rental yield that you get on flats under 40 square meters. And I think that the two key messages in this chart is firstly how yields, if you've been buying small flats and renting them out, you've been getting a much higher yield than you would for larger flats. And real interest rates is the nominal rate minus the rate of inflation. So for example, if you've got interest rate of 2% and inflation of 3%, your real rate is minus 1%. Affordability, this is something that that people look at a lot in Hong Kong, and this is this is work that I've been doing back since the mid 80s, early 80s. In 1997, I estimated that about 70% of the population of Hong Kong could not afford to service a mortgage on a low-end, cheap, small flat of around 50 square meters. In 2016, I calculate that around only 40 to 45% of households cannot afford that same apartment. What's the big difference? Of course, it's interest rates. Demographia is a big organization that publishes a lot of stuff around the world on affordability. But those studies are flawed. They have the advantage in the sense that they are comparable. What they look at is median house prices versus median income. There are real problems with that methodology, I'm afraid. It doesn't take account of interest rates. Interest rates in Hong Kong tend to be a lot lower than they are in many other developed societies. It doesn't take account of taxes. Taxes at 15% in Hong Kong versus 40% in the US. You're buying your house after tax income. They don't take account of that in demographia's work. Also, they're looking at the median house price. To be honest, if we're looking at social policy, we should probably be looking at the lower quintile, the bottom 20%, bottom 25%, because those are the people who we're trying to help get onto the housing ladder. Looking at the median and house price isn't really addressing the problems of the people at the bottom end. It also doesn't address the issue of down payment. Now, this index that I've got here, I've been developing for many years, simply looks at the change in the cost of housing as measured by the mortgage, which reflects interest rate and the property price, and reflects divided by the change in household income. Now, when this line is rising, it's telling us we're getting into unaffordable territory. When it's falling, we're getting more affordable. And if we look where we are right now, we're probably bang on the long-term average. So the affordability picture isn't necessarily as bad as people address here. But the one fault in my methodology, which I'll readily own up to, is that I have not been able to think of a way, statistically valid way, of incorporating the down payment into the affordability. Today, affordability isn't about the cash flow ability to service a mortgage. It's about saving that money to make the down payment. If I could find a statistically reliable way of incorporating that, I think you would find this affordability index is a bit worse than it shows at the moment. So this story, back in 1980, I was working with a big developer here, and I calculated at the time that only about 4 or 5% of Hong Kong's households at that time could afford to service a mortgage on a very low-end, cheap flat in Hong Kong. And I said, I think there's going to be a correction. This is an unsustainable state of affairs. He turned to me and said, Peter, he said, you've been in Hong Kong 9 months. How do you know what we Chinese think? And I said, okay, John, that's a fair comment. But anyway, I said, I think the market's going to come down 10, maybe 20%. Well, I was wrong. It fell 70% in the ensuing 3 years. He's out of business now. Finally, just a quick one on risk. Here we've got in Hong Kong, very low loan-to-value ratios, and those loan-to-value ratios have been declining. So again, doesn't point to a lot of systemic risk in the banking sector. It also tells us that homeowners in Hong Kong don't have huge amounts of leverage, unlike some other places. Stocks, well, stock market, we've seen property stocks were in the doldrums last year. Nobody liked them. They hated them even more in China. They've recovered about 33% this year. Stocks are still not expensive, in my view. They're trading at a little bit more expensive than they were at the beginning of the year, but still below long-term averages. They're still trading at deep discounts to underlying asset value. Short interest in property stocks was very high at the beginning of the year, so the hedge funds and so on hated the sector. Well, they've got their fingers burned. Short interest has dwindled pretty steadily. And I look at net debt to equity ratios in the sector in Hong Kong. These are the lowest geared property companies in the world, without a doubt. You've got some companies here who've got, like Sino Land, has got net cash. Hang Lung, virtually net cash. You look at all the companies in Hong Kong, the average net debt to equity ratio is somewhere in the region of 12, 15, 16%. So these guys are highly underleveraged, which poses very little risk to the banking system from the developer sector, not like we see in China. So that to me is a very positive thing. So we've seen since 2009 lots of cooling measures have been put into the market to try and rein in rampant price rises and so on. Lots of stamp duties, bank lending tightened, restrictions on buying, and supply side, we're going to put more land on the market and so on. It sort of has and hasn't worked. So my sense here, if we look at what's happening, the heat is coming back on in this market again. We're seeing prices up another 10, 11% in the last a few months. So I think the risks in this market are that we're heading back into bubble territory. There's been a primary market focus rather than secondary market focus. Banks are very competitive in the lending market. They've often cut their rates. We've got non-bank financial institutions. Developers are pumping incentives into the system. So I think, if anything, the risk is that we're getting a little bit on the bubbly side. And there's a lot of things that government can do, and perhaps we can talk about these in the Q&A. And I think we're likely, if this price move keeps picking up, we're likely to see government coming back to the table with more curbs on the market. Supply is increasing, but not as much as we expect. China concerns, we know that. Rising interest rates with the Fed, yes, Fed's probably going to raise in December. 25 bips, not much. Volumes have picked up. How long? Could we see more macroprudential measures to cool? The risk in China is a very real risk. I could talk at length about this, but I think China is not going to go off the deep end, but there's certainly going to be some wobbles along the way. I think the non-bank financing in Hong Kong is a growing concern, and I expect the HKMA is looking at this pretty carefully, and we're going to see Fed tightening. Real interest rates low, supply increasing but not huge. Unemployment still low, pretty positive. Wage growth is 1.5% or so, not huge, but not too bad either. But I think that one of the big things here is there's not a lot of systemic risk in either the developers or in the private homeowners. So not a lot of risk from the credit side of the economy going forward. So I'm broadly positive, certainly over the next 6 to 12 months, of the directions of the market, and certainly we can perhaps take some questions on that.
Christine McGee, I'd like to hear your opinion about the impact of the political circumstances in Hong Kong now on the market as it stands, and also in the future. You can choose a time frame.
Yeah, I mean, I think we're all kind of worried about the dysfunction, if you like, in the political arena and in the in LegCo and decision making. And as far as it affects the real estate market, I see it really affecting more the supply side, where you're just having real inability to bring land supply onto the market in a way that is going to quickly address the supply side shortfalls that we've seen. For example, the whole brownfield site business. I mean, in theory, we should be easily able to just go in there, requisition this land, and get it on stream quickly. But we're seeing prevarication, the vested interests put their hands up and create all sorts of problems. We should be, quite frankly, the legislative and the legal machinery is in place for government to get in and take that land, pay people off properly for it, move those brownfield uses out and build housing. But there's just not a will on the part of government to do it. I think this whole thing about rushing off and building in the country parks, that's just a cop-out. That's an excuse, and I personally would think that is not a great idea. Just, you have the ability, you have the legal framework to do it, and you have the capital to do it. You're not short of money, so there's no reason why government can't get in and do these brownfield site conversions. The other thing I would like to see done also is more in the ability to convert other kinds of uses to residential. We've seen it done in many parts of the world, in the UK, in the US, and Canada. Sort of old, obsolete industrial buildings have been brought into residential use. Why can't we do that here? We've got a huge pile of obsolete and old industrial buildings. If you could just get the safety rules done, get all of that stuff sorted, which can be done quite easily, why couldn't we do what they're doing in the States, Canada, and everywhere else, and convert this stuff to be used for residential? So there's lots of things that can be done, but I just see a degree of inability or unwillingness to act, even though you've got the means by which to do it.
Government went through the phase of, instead of having regular auctions, they had the list, and you had to apply to get the premises put on. And developers were then looking at China rather than messing around with trying to get lands department to come in with a sensible price. How much do you think that has affected the drop in supply of new premises?
Well, you know, if you think about back sort of in your day, government would put out a list every year, I think it's in March or April, would put out a list of what we're going to put up for auction in the coming year. And the developers would rush around and say, yeah, we've got to bid because we don't know what's coming up the next year. So a lot of people said, well, that's not a very efficient way of operating. We should just make the list longer, so it spread out over a couple of years so people don't feel they have to rush in a big hurry. And secondly, there was a bit of pressure after the Asian financial crisis to reduce the supply of land because we were in a series of deflation and the developers weren't going to be bidding for it anyway. So I think you had that policy shift happen during the Asian financial crisis, and they've never really reversed it. So, and I have to say the current administration has been trying, and yes, there's more land coming on stream. We've seen it. The supply is picking up slowly. So the government has recognized this, but it's just very, very slow to get this stuff on stream.
Thanks for your point about old industrial property and its neglect of it. The secondary market has certainly lagged the primary market in this rebound. How do you see it over the next 6 to 12 months? Do you see it in tandem or even perhaps outperforming?
Yeah, the primary market has, if you think about the primary market, has been driven by two forces. The first one was the government's relenting on a finer point of stamp duty, where under the stamp duty regime, when you signed up to buy a property off plan, you had to pay stamp duty. But the government relented and said, well, you don't have to pay that stamp duty until you take delivery of the property, which could be 18 months down the track. So that meant, that really encouraged buyers to come in and buy off plan, because that then gave them 12, 18 months, 2 years to find a buyer for their existing property, so that they didn't have to carry that stamp duty over that building period. So that really helped the developers quite nicely. But it, of course, penalizes the secondary market. So you're giving a bonus, if you like, to the developers, and you're hurting the secondary market. And the second issue we've seen this year which I haven't seen for quite some time, is that developers are rushing out giving all sorts of incentives because we know the affordability is stretched. When if you have to put down 40 or 60 or 70% of your down payment, who can afford that? Who's got that savings to do that? So the developers coming in and the non-bank financial institutions coming in and giving top-up loans and incentives to allow that top-up to say 80%, then you only have to put down 10 or 20% of cash. That's really encouraging the primary market much more than it is the secondary market. So, but in the last month or so, we've also seen the secondary market pick up a bit as well. So maybe it's a bit early to say that the secondary market is gathering strength, but I'd certainly like to see the secondary market gathering some strength, because at the end of the day, that's what allows people to move and upgrade and so on and so forth. If you can't move and you can't upgrade, it's very, very difficult for middle-class families. So hopefully the secondary market, I would like to see stamp duty cut right back, of course, we all would, but the way things are going, I can't think that the government's going to be under a lot of pressure to do that right now. But we would certainly like to see stamp duties cut in commercial. You mentioned commercial premises. I think the stamp duty on commercial is just totally ridiculous. It's not necessary. You can understand why it's for residential, because it's affordability issues and so on and so forth. But that's not the case for commercial. And I asked a government official on a radio program one day, I said, why has the government done that? And he looked at me and he said, well, you can't have a different stamp duty on commercial property as you have on residential. Of course you can. That was the weakest, lamest excuse I've heard in a long time. So commercial, they should just abolish that extra double stamp duty and just take it back to where it was historically.
2 questions, if I may. A lot of government leases expire in 2047, and a lot of people are pretty twitchy about that.
Yeah.
Should they be?
You know, people in Hong Kong are pretty smart. You think people understand time and time value of money and all that kind of stuff. Well, they don't. If you go to the UK, if you've got a property with a 50-year lease versus one with a 100-year lease left to expire, they could be next to each other. They're different. Prices are different. In Singapore, you go look at a property which has got a 99-year lease and a freehold right next door, same property, same developer, same quality. There's a 15 or 20% difference. People pay more for the longer lease, for the freehold. In Hong Kong, they don't seem to. They don't care. And I had, I chair the Real Estate and Infrastructure Committee for a number of years at the General Chamber of Commerce, and we had an expert come and talk about this. And he said, look, he said, don't worry about it. It's not an issue. And I tried to press him on it, and he said, well, look, even now, leases are being granted for beyond 2047. So this is not going to be an issue. The 2047 date isn't a drop-dead date on leases. Already leases are being extended. Now, I assume he's correct. I hope he's correct. So I can understand why people aren't getting terribly cut up about it, but it's certainly an issue that I would like to see more deliberate policy clarity on for sure, because in 5 or 10 years from now, we're going to be facing this, and if it's not clear in the legislation, it's not clear in policy what's going to happen, then that could be a very, very big negative for Hong Kong.
One more quickly. When you look back at the ghastly ghetto that Tin Shui Wai has become, what lessons do you think we've learned for building new towns?
Yeah, I think the issue with Tin Shui Wai, it was planned as a self-contained new town with public housing, private housing, and job centres, industrial estates, job centres, business centres, and so on. Well, when it was taken over by the government, they had this huge surge of migrants coming in from China. What do you do with them? So what they did was they cancelled all the job centres, all the sites that were designated for industrial and industrial parks, business parks, and so, cancelled them all in public housing. So there are no jobs. They took away the jobs and put public housing. Now, they solved an immediate housing crisis, but actually created, I think, a long-term social problem. And how do you fix it now? I'm not sure. So you end up with a highly unbalanced population, hugely skewed to public sector housing, also to large numbers of immigrants from China, single families, single parent families, and so on and so forth, and there are no jobs. So how do they get to jobs? So that it's really the original planning under government guidance was correct, but they succumbed to this short-term problem of housing back in the mid to late 80s, which has left them with a legacy problem, which I'm not sure how they're going to deal with it, or how one does deal with it, other than to perhaps create lots more jobs nearby. And that is happening to some extent, but it was never, it's coming late, much later than it should have.
Last question at the back.
What factors or things that would need to happen in the market, in your view, before the government loosens up these tightening measures? For example, stamp duty relaxation or bank lending, not requiring such high levels of down payment, or and people not having to rely on these non-bank institutions.
Well, I think if we saw property prices correct by 30, 40, 50%, then I think you'd have every reason for government to give up and roll back those controls. Just for example, like you saw in China, they put in all these macro-prudential controls in 2010-11, or 12, and then they rolled them back last year. They're about to put them back in again in China. So they're going through these cycles of putting the controls on, taking them off. Hong Kong's put the controls on and hasn't taken them off. I think the only way that they would contemplate that is if you saw a serious correction in the property market. And to be honest, if we looked at from August last year till February, March of this year, you thought we may have been facing that. You've looked at my notes there, Li Xiaoqi from Henderson Land was quoted in the press at one point of saying property prices are going to fall another 30%. Well, of course, when he said that, they really immediately rebounded 10%. So if he had been proven correct, I think we would now be facing the possibility of a rollback of some of these macro-prudential control measures, but we're not. And we've still got zero interest rates. We've still got, the whole world is in a zero interest rate environment. We've still got capital flows coming in from China, other parts of the world. So we've got a liquidity issue. So I'm afraid, I think we're going to be living with these measures for some time to come.
Thank you very much, Peter. That was very insightful.